Okay, good afternoon, folks. We'll be kicking off in 30 seconds or so. The numbers are climbing up. We generally have close to 1,000 people attending these webinars, but it does take a minute or so for people to get in. Rightio, let's kick off. My name is Peter Armitage. I'm the CEO and Co-Chief Investment Officer, along with Nolan Barpiner of Anchor Capital. And every quarter, we're delighted to bring people our perspectives on investment markets, how we see the world, and where the money will be made over the course of the next 12 months. We typically give some 12-month forecasts of what we're expecting from investment markets and different asset classes. And you'll be joined today by a range of our fund managers and analysts who are going to run us through all of that. So to detail things in summary, we break it down into domestic equity and fixed income, and likewise global equity and global fixed income. Interestingly enough today, and for the first time in quite some time, we actually think you've got a pretty good chance of getting the best rand return out of domestic equities. We're certainly a lot more bullish on global equities long term. South Africa is stuck in a 1% GDP growth conundrum. But we think there have been a lot of tactical reasons why the SA markets have underperformed quite considerably. So we're looking for an 18% return over the next 12 months in our base case scenario, but that obviously does come with some risk, given the different potential election outcomes. Our domestic market is also heavily influenced by China, and some further recovery of what appears to be happening in China could be positive for our market. Moving across the globe, remembering that SA equities are less than 1% of world markets, in fact, only about 3 or 4% of the emerging market index. Global equities are a lot more relevant to high net worth individuals. And what we've had a pretty good 6 months across the global equity space. The US economy is strong, with close to full employment, and the US earnings outlook for the next 3 years, kind of from the end of this year onwards, looks pretty positive. Higher interest rates could stay higher for longer, and hence things could be delayed a little. So we're not forecasting a dramatic double-digit return from global equities, given what they've done, as starting valuations are quite high, but we would stay invested, and we're looking for a 7% US dollar return. Nolan will run through the domestic fixed income world. We're looking at returns on our portfolios of between 9 to 10.5%. And across the globe, I think what's changed dramatically in investment markets from 10 years ago to now, and only for the last kind of 12 to 18 months, is that you can earn some inflation-beating returns without taking equity risk. Our global high yield fund is showing a US dollar yield of 5.5%, with bonds maturing in 2026. So a fairly high level of certainty that that's the return that you're going to receive over the course of the next 2 years. So that's our summary of where things sit. This is shown in a picture below. Domestic equities up 18%, bonds 14%. We haven't talked about property. The property yields, the dividend yields that you're getting out of property shares that are also fairly beleaguered, is about 9 to 11%. Some SA shares you can even get as high as 12%. And we think as interest rates come down, the prospects for property company earnings will increase. So again, a pretty an overweight position in the listed property space. We once again, over the course of the last 2 years, especially as interest rates have increased, we've been banging the table on alternative assets, where there's some pretty good potential returns available without the volatility that comes with equities. And in fact, we've got a lot of high net worth clients who found the intense equity volatility over the last 4 years quite hard to stomach, and have moved across into the alternative space, where we've been registering double-digit returns. From a global perspective, we talked about 7% for equities and kind of mid to high single-digit returns across global asset classes. So we think it's still a reasonably good time to invest. Some caution on global equities given what's happened, but that's basically the picture. I think we came across this fairly interesting chart. Goldman Sachs did a family office global survey in 2023. And it's always interesting to see where the big piles of money offshore invest. And this was the average asset allocation of global respondents. 30% in public equities, 12% in cash and cash equivalents, and about 10% in fixed income. So 50% in listeds and cash, and 44% in alternative markets. Now that includes private equity, private real estate, hedge funds, private credit, etc. Last year, Anchor launched a range of alternative funds. We have a local fund of alternatives with a 10 to 15% Rand objective, a global fund of alternatives with a 10% objective in US dollars, and a global alternative yield fund, which currently is at a running yield of about 7.5% in dollars. And a range of these products give equity-like returns with a stable return profile. So just looking at the guiding number around the world, and later on in this presentation, I'm going to be having an interview with Thomas. He's going to tell us the relevance of the US 10-year government bond yield, which tends to be one of the key investment indicators around the world. So what you can see from this chart in the brown line is that for much of the last 10 to 15 years, you've had interest rates at close to zero, and now they're sitting at the highest levels since about 2006. So it changes the price of money, it changes the rates and the expectation of capital, changes the cost of capital, so a significantly different investment outlook and returns available in different asset classes. We always, first and foremost, guided by global GDP growth, which effectively represents the stage on which we're operating. You can see that's averaged about 3.3% over the course of the last 20 years in this graph. Only one big negative year, and that was COVID in 2020, but a quick recovery in 2021. And what we're seeing for the next 2 years is pretty solid growth coming through, buoyed quite significantly by the US, which is doing a lot better than people expected, with Europe and the UK proving a bit of a drag. Then global equity markets, we largely talk about the US markets. They represent about 60% of global market capitalization. For example, a lot of the big tech companies around the world operate around the world, but they're physically listed in the US. And here, there's about a 9% earnings growth on average over the last 20 years. And the equity return that investors get tends to mirror that, because valuations go above and below, but tend to revert to the mean. Now, for the next 3 years, we're looking at an average of about 10 to 11% earnings growth, which augurs well for equities. The US economy is doing much better than people expected a year ago. I don't think there was one big investment bank around the world that wasn't forecasting getting close to a recession by midway through this year. So there's lots of ammunition in the gun. If things do start slowing down, interest rates can get dropped quite quickly, but Nolan will run through more of that. So the conditions are fairly good for equities. Good earnings growth coming through, some very interesting drivers in artificial intelligence and obesity drugs and the like. But I guess it's no surprise that when prospects look fairly positive, valuations are fairly high because people have pretty positive expectations of the future. And where we're sitting today, this is the MSCI World Index, is a forward PE multiple of about 19. And as you can see from this chart, the average is about 16. So we're sitting close to 20% above the average. That doesn't mean poor returns. If earnings growth continues to come through, you can still get pretty decent returns from stock markets, but there isn't much room for error. So, with a client who's fully invested, we tend to encourage them to stay heavily invested in the equity space, although that doesn't mean that you can't have a bit of a bumpy ride along the way. And from October last year, you've had pretty much one-way traffic. Over the course of the last week or two, we have seen a little bit of weakening. So then we move into the alternative asset space. What are they? Private equity, private debt. Private debt's become a very interesting space around the world and gaining a lot of attention. We invest a fair amount of capital, private client capital in the space, and we're achieving kind of 9 to 9.5% pound returns. And we think a risk that it's pretty low relative to the yield that you're getting. Real estate, we haven't presented clients with any new real estate opportunities over the course of the last 6 months, but certainly high interest rates are putting pressure on prices, and we're anticipating some opportunities coming through. Our suite of hedge funds at Anchor Capital's developed some very nice track records, and there's some interesting risk return profiles that are being created. And we have got fund of hedge fund products, which also gives clients the opportunity to invest across the spectrum without taking the risk of a particular fund. Infrastructure's another space included in alternative investments, and then structured products we've found very profitable over the course of the last year or two, and something that we're marketing to clients as a nice place to be, especially when the equity market's already done quite nicely. So that's a quick run around of the bigger picture of where we're seeing equity markets, where we're seeing asset class returns. And I'm going to follow on now and pass over to Liam, who's going to talk through local equity markets, where we think there's opportunity for some money to be made in the next 6 to 12 months.
Thanks, Pete. Sure. So while you were discussing the range of outcomes for global equities and where they sit relative to the longer term means, I think the situation in South Africa is clearly very different. And that comment that you made around not necessarily guaranteeing a bad outcome. I mean, I think just in terms of the JSE, very low multiples certainly doesn't guarantee a very good outcome. So with that in mind, just to take a step back and take a look at what South Africa has done relative to global equities over the last couple of years. And our conclusion is along the lines of that's enough for now. So South African equities have underperformed by about 40% relative to global equities since the end of 2022. So in the first quarter, they did -7 in dollars. In the rand was a touch weaker. So in rand's terms, you're looking at around -4. So that's, in the contrast of global equities, which put in a +8 quarter, it's just a continued underperformance of South African equities. Now, the sheer extent to which it has underperformed has obviously prompted us to take a proper look and finally conclude that, enough is enough. And we've taken a fairly uncomfortable and slightly bold view that on a 6 to 12 month view, there's enough in the bottom-up investment case of the JSE to suggest that there's a good chance that they're going to outperform global markets. Now, as you can imagine, that's going to cause quite a lot of debate, which we encourage. But really, to summarize our view, we think 18% total return in dollars is not an unlikely scenario, including that obviously includes getting onto the other side of the elections that are come up next month with our base case that the ANC gets a plus over 40% of the vote, probably somewhere in the mid-40s. Our fixed income team has done quite a lot of work on that, going through the various polls. And no doubt that thesis has been tested in the last couple of weeks with recent polls coming out suggesting that the ANC could drop below 40. But that's certainly not our base case. And just to reiterate, we are not pollsters or election forecasters. We're investment analysts that are currently in the process of just trying to scenario plan. So and this election is incredibly pivotal in terms of our expectations of JSE returns going forward. And also to just summarize that, some of the factors that have pushed JSE equities down over the last certainly quarter last year could potentially become tailwinds in the coming quarters and 12 months ahead. So things like load shedding, which was a huge issue last year, and that could potentially become an earnings tailwind for a lot of our companies. The changes in the regulations in South Africa that have allowed the funds to take more offshore, tens of billions of rands have left the JSE. While that might not come back to the JSE, it certainly had quite a negative impact. And if that doesn't reoccur, which is unlikely to do, that selling level will also start to drop off. So with that in mind, we think that there's potential for a short cycle recovery, tactical rebound in JSE equities. And obviously the interest rate environment that we find ourselves in is different to what we were discussing in the first quarter webinar, where interest rates and expectations in South Africa have been pushed out along with global interest rate expectations, which the fixed income team will discuss after me. So those factors we think that have created an opportunity to go tactically overweight, because we think that there's enough in it from a bottom up, suggesting that the JSE could rebound certainly post the elections. Just in terms of taking our minds back in terms of what the JSE used to look like relative to both emerging market and global equities. So just worth highlighting that the JSE where the JSE really used to sit in the global pecking order. I mean, we 10 years ago, when I was first starting out as an analyst, it was not uncommon to see 50, 60% premiums to EM valuations for JSE listed companies. That erosion of valuation levels really kicked off post the Cyril Ramaphosa. I think it started around the time that Zuma fired Nene and hired Des van Rooyen, but really kicked off when I think a lot of foreigners were very disappointed with the Ramaphosa regime not having fixed the systemic problems in South Africa. But going back in time, 50% premiums are not uncommon. Our banks used to trade comfortably at 2 times book. A lot of our industrials in the mid double-digit PE multiple range. And foreigners are very fond of the JSE. I mean, it's very difficult to remember that time now because of everything that's happened in South Africa. But, you know, and certainly not our base case that we're going to get anywhere near to that level of re-rating and investor appreciation. But certainly just to show what can happen if there's positive change in the country. We certainly, and this is relative to emerging to global equities. So, you know, relative to global equities, when you look back at the last 10 years, we used to trade on round about on par. And, you know, relative to EM and relative to global equities, we've gone from on par, you know, reasonable premiums to significant discounts. And, you know, the structural issues in South Africa are certainly not going to go away. But we think some of the more technical factors that have resulted in recent derating are relative to global equities likely find itself in the rearview mirror in the coming year. So now, and certainly not insinuating that there's about to be regime change in South Africa. That's not the case. If there was regime change in a positive direction, a more pro-business direction, you know, as you can see what's happened in Argentina, you know, the upside to our stock market would be immense. You know, it wouldn't, what's happened in Argentina with the banks there, I mean, you're looking at 100% upside in very short spaces of time when the market thinks that something like regime changes happen. That's certainly not our base case here. But we also want to just appreciate that in recent, I guess, months with what's happened politically in South Africa with the MK party and further eroding the base of the ANC, there's certainly an increased level of tail risk within our local market. So we are cognizant of that, but not our base case that the ANC dips below 40, which would be quite a vulnerable outcome for us as investors to try and plot out exactly how to position portfolios for that world. Then just to get to how we got to our forecast total return. So essentially we've taken the MSCI South Africa index, and it's quite similar to the capped SWIX. There's similar of the 3 buckets where the domestics account for about half the market in South Africa, and then the rand hedges and the commodity stocks the other half. In South Africa, we think that if you just revert back to the mean of the past 5 years in the domestics. Now, the past 5 years have included a dramatic increase in the risk-free rate in South Africa. It's also included the July unrest that happened a couple of years ago. It's included COVID, and included when we got up to stage 6 load shedding. So we've been through quite a rough ride over the last 5 years. And even with taking all of that into account, the market still trades at quite a big discount to the mean of the past 5 years. But if you can we think if you can get to the other side of the elections and you can get some kind of re-rating, even back to that mean level without any tailwinds from things like interest rates cuts, which is obviously quite a big earnings tailwind on the JSE, and it would increase the multiples that we would be prepared to pay for companies, just to get on that back to the mean of the past 5 years, which includes obviously some pretty troubled times in South Africa. We think that there's at least 10% upside just on the back of that for our market. And then, you know, you can add in the optionality of a recovery in China. I mean, it certainly looks like China is trading a lot better in probably the last month or so. And certainly it looks like some of our key commodities have bottomed in South Africa as well. So if you add in the optionality of that, we don't think it's a completely bizarre set of circumstances, or it wouldn't be completely bizarre to see the JSE up in the region of 15 to 18%, which is, you know, when you look at the optionality of the JSE relative to global equities, we think that the risk return is actually quite skewed in the favor of the JSE. We wrote extensively in the Navigator about the impact of the changing outlook for interest rates since the start of the year. So, you know, us as a team, we had quite a few more interest rate cuts priced into our equities. We were looking for quite a strong tailwind to earnings on the back of that, particularly in our domestically focused companies, our banks and the retailers, which we think will be very positive for them. That being pushed out, you know, potentially 6 to 12 months out. All it's meant is that you know, the earnings tailwind that we should expect to see has been pushed out. We think that there's still a good chance that, well, it looks highly likely that they will eventually cut interest rates, but that's just been pushed out. And all of these factors together has provided us with quite an interesting tactical entry point into the JSE. You know, we're seeing COVID low valuations on a lot of our companies. You know, they're not nearly as distressed operationally as they were back then. And yeah, I think on a risk reward basis, it's you know, uncomfortably so, but we think that it could be a good time to invest in JSE equities. And with that, I'm going to move on to Nolan to discuss fixed income.
Thank you very much, Leo. Appreciate the opportunity to chat here. Just waiting for you to stop sharing the screen so I can pop mine up there. But welcome back, everybody. It is absolutely wonderful to be speaking to you again. It's been a very, very interesting quarter during which you know, a lot has changed. And I'm going to, again, talk to you about the fixed income side of things. I'm going to talk to you about the Rand. I'm going to kind of pull together Anchor's views on where the money will be made. And I'm going to do that over the next 15 minutes or so. As always, I'm going to start by looking at the global environment. And the reason I do this is, firstly, you know, global fixed income is obviously very relevant to a lot of people, but it also sets the backdrop for everything that happens in South Africa. And I'd go as far as to say the global environment probably dictates somewhere between 60 and 70% of what happens to our domestic financial securities, whether they're equities or bonds. So very important to start with that, very important to sort of understand the world we live in. A quarter ago, I sat here and we were talking about the upcoming interest rate cuts. I had a chart, a variant of this up at the time. And what this chart is doing is it's looking at the number of interest rate cuts of 0.25% each that investors were expecting for 2024. So in other words, how many interest rate cuts are we going to get this year? And this is the view back in January. Most common, or most of the investors in the poll were saying we're getting 6 cuts. Over, you know, almost 40% of investors of the view that we're getting interest rate cuts of about 1.5%. Some were pushing it up to 2% of interest rate cuts, and the most pessimistic people were talking about interest rate cuts of 1% this year. So broad consensus, interest rates were coming down, interest rates were coming down quite quickly. What happened was the first quarter of 2024. Liam's already alluded to it, Pete spoke about it. US economic growth was a lot stronger than expected. We'd actually been saying expect stronger economic growth, expect interest rate cuts to be less than this. It was significantly stronger than we'd called. At the same time, every time the US put out its inflation numbers, they were a little bit higher than people were expecting. So inflation has continued to come down. If you look at the 12-month numbers, you know, inflation continues to come down. It's just coming down more slowly than we expected. And it's coming down more slowly because economic growth has been a lot stronger. So what does that mean? Well, those interest rate cuts, just look at that chart and look at how it has changed. Everything's shifted to the left. Interest rate cut expectations, as at a couple of days ago, similar poll, are that we're going to get somewhere between 0.25% and 0.5% interest rate cut this year. We expected 1.5%. We're only going to get, maybe if we're lucky, 0.5%, massive reduction in interest rate cut expectations. A quarter ago, I sat here and I said to you, well, the market feels a little bit too aggressive in its expectations. Today, I can at least sit here and say, yeah, we actually think that's probably about right. Where does Anchor come out? It comes out at 2 interest rate cuts in the US this year. That's got a massive impact on the market in a variety of ways. So let's talk about those. And what we've got on the left-hand side is a chart. It's showing you the yield on the US 10-year bond. What is the yield on the US 10-year bond? Well, basically, if you think about it, it's kind of the average of what investors expect interest rates to be over the next 10 years. And that has pushed up. Why is it pushed up? Because if they're not going to cut interest rates, we expect interest rates to have a higher average. So that's been a very meaningful movement actually over the first quarter. And it's almost dominated financial markets because outside of US equities, I'll touch on that in a second. What you have seen is the cost of capital has gone up again. Bond yields have gone up. Now, rising bond yields are very bad for bond prices. So a lot of fixed income investors have actually found this to be a very trying period, a very difficult period. And that's sort of then filtered through the rest of the market. But there are some takeaways from this, and I'm going to start with the middle point, actually, point 2, which is the US economy is stronger than we thought, and that's become very clear. So the economy, we've seen interest rates hike to 5.5% Fed funds rate in the States, and the market's kind of shrugged that off, and the economy shrugged it off and has kept going. So that's great news for equities because, equities benefit from a stronger economy. It means earnings can grow faster. Peter was talking about earnings growing faster. And this economy is going to continue to support that equity sort of dynamic into the future. And we actually do think that strong economy has got further legs. But the other point we've got to make is, well, if your economy is growing quite strongly, it's actually very robust, you're at full employment. Why would you actually cut interest rates? Does it make sense to cut interest rates? And that's something that the market's been wrestling with because, back in January, the market thought that US interest rates were going to be cut from 5.5% to 2.5%. The market was talking about 3% cumulative interest rate cuts, of which maybe 1.5% this year, 1.5% next year. Total interest rate cuts at 3% and it becomes an investor bonanza. Now the discussion in the market is saying, well, why would you actually cut interest rates that far given the economy is so strong? Maybe we need to cut less. And the broad perspective in a recent poll is that US interest rates now only need to be cut by about 1.5% in total. That means, in our view, 0.5% this year, 1% next year. And you say, right, we've arrived at the new sort of fair interest rate, which is a lot higher than previously. And that's got a massive, profound impact on the investment horizons. Make no mistake that interest rate cut of 1.5%, 0.5% this year, 1% next year, is still going to be quite a positive event for the markets. It's still going to be a positive event for various financial assets, both abroad and domestically. And finally, the point I'm making as well is interest rate cuts are still going to come. There are good reasons that the Fed is going to need to cut interest rates. I continue to take the view that the Fed is going to cut this year. It's just they're going to be a little bit later than we'd originally hoped. But interest rates cuts will come, and time to think about that. So where does that leave us from where the money will be made? Well, cash remains interesting. Right now, your risk-free asset is yielding 4.5% in US dollars. And that actually is quite appealing, particularly because you're actually earning well above inflation rates right now on cash. It is a great time to lock in higher interest rates. I've said this before, but right now, the likelihood is that we will get interest rate cuts in the future, certainly in the next year or two. And from that perspective, it's an opportunity to lock into higher yields. We think that the opportunity set lies within the 4 bonds that have a 4-year maturity to a 10-year maturity. So we're saying lock in yields, these high yields for periods of 4 years to 10 years. That's going to give you a better outcome in the long run, even though it's going to be a little bit volatile in the short period. And in terms of how do we do that, The portfolio I like is the Anchor Global High Yield Fund. It's earning a relatively steady yield of about 5.8% right now, lower duration bonds, beating cash, beating bond yields, not going to be particularly volatile. So from that perspective, we really like that portfolio at the moment, and it's actually done very well for our investors since inception. But of course, we've then got to sort of take that backdrop I've outlined, and we're going to talk about what's happening domestically. And domestically, I'd summarize the South African investment environment as hurry up and wait. And what I mean by that is everyone's constantly looking at South Africa, and South Africa's cheap. Whether you look at our bonds, multiple measures, they're cheap. Equities are cheap, but you're looking for that catalyst that will sort of spark the explosion. What's going to change? And, you know, we're all waiting for Eskom to reduce load shedding. We're all waiting for Transnet to improve logistics so we can export minerals. We're all concerned about El Nino that's going to, unfortunately, dampen food supply in the country. It's, you know, we're looking at a drought. That's bad for food prices. It means inflation potentially a bit higher than we'd hope. We're waiting for the National Prosecuting Authority to do something. We're waiting for water to be resolved. We're waiting for US rates to be lower so the environment's more friendly, the search for yield, and all these things we spoke about. At the moment, the big one is we're waiting for the election. We're waiting for that to get passed, and then once the election's out the way, things will feel better. And that sort of sums up South Africa. I think we're constantly looking at it and sort of waiting for improvement on various factors. And the point I'm at the moment is, if you look at these factors, I think that on the margin, most of these are actually improving. Eskom, we are seeing less load shedding than we did last year. Transnet, the plan around private sector involvement is actually starting to make sense. I'm seeing actually talk of less vandalism taking place as well. In terms of the El Nino, it is something we've got to obviously work our way through, but it's beginning to look like we might be okay on that. US interest rates, we've spoken about rates going down. The election, as Liam was saying previously, Anchor is not a sort of analyst or a pollster, but our base case is that the election ends up in what I'd call a benign outcome. So, it's not going to be the worst of outcomes that we're seeing in the press. And a lot of people are putting things in the press right now because it's an election period, it's silly season. And even the polls themselves, I saw a poll the other day that came out with the ANC at 18%, and you just scratch your head and wonder how that happens. But the truth is that that's not a realistic outcome. So from that perspective, the realistic outcomes, I think, are probably relatively benign, and things are improving. So that gives us a bit more confidence for South Africa. And I'd sort of summarize South Africa as a coiled spring that's got a lot of risk premium in it right now, and that risk premium is probably excessive. I think there's an opportunity for the risk premium to reduce, and that's quite positive for South African assets. Our base case for South African fixed income is, as I said on that slide, the portfolios are going to yield between about 9% and 10% over the next year. Interest rates in South Africa are high. That actually makes your cash investments, your low risk investments, quite attractive. We love the Anchor Core Income Fund. It's yielding about 9.3%, and it's your steady eddy. It's just every month you get your 0.75% return. You add it up over 12 months, you get your 9.3%. And it's really just a comfortable place to be right now. Interest rates are going to remain higher for longer. We therefore think that this portfolio continues to have a lot of attraction. We do, however, expect about 1% of interest rate cuts in South Africa over the next 18 months. I think that inflation will continue to come down, and coupled with the softer economy, it just makes sense for South Africa to cut interest rates a little bit. We're not going to cut as much as the US is, but if we get our 0.5% of interest rate cuts this year and 0.5% next year, I think that's about as good as it gets. The expected returns on portfolios, as I've said, are sort of, your fixed income returns this year is going to be 9 to 10%. We also love the BCI Flexible Income Fund because it gives you the best combination of steady eddy, stable returns, stable investments, but at the same time, it gives you an opportunity to invest in, some assets, risk assets that could, if South Africa does benefit from this, a bit of a positive repricing, it'll give a bit of a boost, a bit of a pop to that portfolio. And that's quite exciting for us. Finally, talking about the South African rand, you'll have picked up that I'm quite excited about South Africa at the moment, that I'm quite excited that things are going to be a little bit better going forward. I'm not talking about a vast change, but a slight improvement. And that carries through to our rand view as well. A quarter ago, I sat here and I said, look, the rand probably trades around 19 to the dollar. At the time, it was actually a very, very brave forecast because most of my peers were coming out with numbers like 17 and 18. And we were actually one of the most pessimistic in the market. As it turned out, the rand did trade around 19. We've reduced that expectation to about 18.5. In front of you, you've got the purchasing power parity model graph that we use. We've used this for a number of years now, and you can see the blue line, jagged line, which is kind of where the rand is, and the sort of broad line, broad brown bar, which is where we think the very value of the rand is. Conclusion is the rand clearly is not listening to my chart. It's significantly weaker than my chart. Makes sense for the rand to be weaker than my chart. We've got a lot of risk factors and a lot of risk premium in the rand. That risk premium is here to stay. It's certainly going to be up for a while. But the point is, I think the risk premium can reduce ever so slightly, and hence the view that the rand probably sees a little bit of strength, a little bit of tailwind. And we're talking about the rand now trading around about sort of 1850, which is a slightly sort of stronger range than we've seen in the past. So that sums up the fixed income views. It sums up our rand views and a discussion of our asset allocation. So with that, I'm actually going to hand over to James Bennett, who's going to talk you through sort of an interesting investment case that we've looked at recently. Thank you.
Good afternoon, everybody. It's James Bennett here. I'm a global equity analyst. If you haven't heard me present before, this is actually my 30th year in the market. So I've been looking at stocks for a long time. We've obviously done quite a bit of top-down stuff today, so we thought it would just be interesting to talk about a couple of interesting global stocks at the moment. Both of the companies we're going to talk about are auto companies, two very, very different businesses from each other, and also two companies that are very different from the broader auto cycle as well. So the first one we're going to talk about is Ferrari. Now, Ferrari is a truly phenomenal business. Most people think of this, maybe if they don't know too well, just as more as an auto company. But what we would say is that this is really probably, together with Hermes, one of the world's great luxury goods companies. And we've put a couple of interesting quotes on here that maybe are a little bit amusing. The one is that Ferrari are very good at saying no to people. You're not used to taking no for an answer. And then the other interesting stat is that Porsche sold more cars last year than Ferrari has in its entire existence. Ferrari only listed in late 2015 when it IPO'd. It's got a listing in the US as well. And I guess we can look back with the wonderful benefit of hindsight and say what a phenomenal business this company has actually been. If only we had all bought some shares back in 2015. It's not a stock that we hold widely at Anchor at the moment. It's a business that we are very much in favor of. I think we've maybe just struggled a little bit with the valuation to try and find an entry point. But I think any kind of sell-off in this business, a temporary sell-off, could potentially present quite a good buying opportunity. So again, as we said, this really has all the markings of almost what we would say an ultra high quality, luxury goods company, $75 billion market cap. So it's already a pretty sizable type of business. There's something that's called the Lindy effect. And what this is that the longer that a non-perishable item has been in existence, the longer it's likely to remain in existence. Now, this is not an absolute. There are some companies like Revlon a couple of years ago that had been in business for 90 years that did fail. But it's certainly fair to say that, especially with these European companies that have been in existence almost for generations, that they are likely to be with us for some time to come. So the fact that Ferrari's been in business for over 80 years, it's unlikely that this business is going to disappear in the next 5 years. And I think it's something that, the heritage of these European luxury brands, very, very difficult to replicate. You can't just say, well, I'm going to start a new luxury brand in the next couple of years and compete with these European companies that are basically been around for generations. So that's certainly something in Ferrari's favor. I think this is probably the most crucial point to understand about Ferrari, is that its production is very small. So this is a company that only sells about 13,500 cars a year. So it makes it very defensive if there is some kind of economic slowdown when your volumes are so small. And bearing in mind that your typical Ferrari customer is not somebody whose buying of that Ferrari is dependent on their salary increase or the bonus that they got in the last year, but it's usually based on a very high level of net worth that has been accumulated over a long period of time. It was interesting that Ferrari even got a mention from Warren Buffett at the Berkshire Hathaway AGM last year. He was talking and saying how he thought that generally auto stocks didn't make great investments, but then he just mentioned Ferrari and said, you know, this is an exception to that rule. You know, it's a pretty special business. And then he made reference to the fact that they only sell, you know, about 12, 13,000 cars a year. If we look at the breakdown of Ferrari's sales, so 93% of their volumes are what they call range vehicles. And what they just mean by that is the so-called everyday Ferraris. And then a very low percentage, about 7%, is what they call special edition cars. Now, it's a low percentage by volume, but a very high percentage by value. And I'll come back to that in a minute. So here's just the history over the last 15 years of the range Ferraris that have been released. And you can see it's a very long range of iconic models that get released every year and then remain in production for a few years. Just that arrow that I point to there at the bottom, the Ferrari Purosangue, that is their first SUV that they released last year. Unlike some of their luxury competitors, they've committed that SUVs will never be more than 20% of their sales. That SUV costs about 10 million Rand, and it's already sold out for the next 2 to 3 years. What's quite good with Ferrari as well, is that currently only about 11% of their sales come from China. There's obviously a big debate about whether you want high or low exposure to China at the moment. I think at least in the case of Ferrari, you've got exposure, but the risks are clearly all to the upside. Now, a typical range Ferrari goes for about $250,000 prior to any customizations being done. And then this is around about 7% of their volumes, which is their limited edition models that they release every year as well. Now, typically, you'll have a production run of a couple of hundred cars. They'll be sold out before the first car is even produced. And the interesting thing here is that you actually have to be invited to buy one of these cars. Now, Ferrari has never published a list of what it takes to get on this list, but I would say that car enthusiasts over the years have put together a list of do's and don'ts. Some of the don'ts include you probably don't want to be a social media influencer. You probably don't want to have a history of slagging off Ferrari. Any aftermarket modifications that are done outside of Ferrari will probably knock you off of that list as well. The do's include, being a reasonably regular visitor to the Ferrari head office and factory at Maranello in Italy, attending the Ferrari track days that they have around the world. And some would say that owning at least 4 Ferraris at that point in time enhances your chances. Now, I've drawn an arrow there halfway down next to the LaFerrari Aperta, a limited edition model that was released in 2016. It cost $1.4 million, or about 20 million Rand at the time. And there's an interesting case of a very renowned Ferrari collector who wasn't invited to buy one of these 200 cars. He was pretty upset about this. Now, his reputation at the time, he had a Ferrari collection in excess of $100 million, at least 15 cars at that point in time. When he failed to get an invite for whatever reason to buy this car, he appeared to have done something to upset Ferrari. He actually sent a check for $1 million deposit to the then CEO of Ferrari, and the check came back 3 days later unbanked. He then proceeded to sue Ferrari for having the temerity not to invite him to bid for one of these cars or buy one of these cars. And the basis of his claim was that Ferrari had damaged his reputation as a Ferrari collector. He did subsequently withdraw his case against Ferrari. So the question might be, well, why would somebody go and pay, $1.4 million to get onto the list for a limited edition Ferrari? And the answer is that if you get one of these cars, they are almost immediately worth a few $100,000 more than you just paid for them. Now, there are some restrictions there. Ferrari does frown on people flipping these cars. You are expected to hold them for at least 12 or 18 months. And obviously, if you develop a reputation of buying these and then flipping them fairly quickly, the chances are you won't ever be invited to buy one again. But it is a phenomenal ecosystem. And that raises an interesting debate with Ferrari, whether you should buy the physical cars or whether you should invest in the shares. And the answer is quite nuanced. So if you look at the regular range Ferrari, as we're speaking about on the previous slide, the answer there seems to be that those will slowly depreciate in hard currency terms, probably a little bit slower than a normal car, but probably won't make a great investment. Obviously, in a South African context, people have used them as a little bit of a rand hedge. But when we hear about these anecdotes of people having made phenomenal returns owning a physical Ferraris, it's usually come from one of these limited edition models, and usually one where there's a bit of a racing heritage associated with those cars as well. So, to each their own. There are some phenomenal stories of returns people have made on these limited edition cars over time. But I guess for the average person out there, maybe you'd be better off just buying the shares, which have also been a great investment. Probably the single most debated point about Ferrari at the moment is the oncoming EV market. And we would say that probably, if anything, this EV market could even be an enhancement for the Ferrari brand. And here's a few points to consider. From an environmental perspective, bear in mind that Ferraris are sold in very small quantities and driven very little. So Ferrari has very low utility value. Almost no one buys a Ferrari to drive from point A to point B, which is very different from a few slides on where I'll talk about Tesla. Also bear in mind that half of Ferraris sold now are already mild hybrids or plug-in hybrids. So Ferrari's negative environmental impact as a company is extremely low. And one could actually say that for most people who buy Ferraris, it's more a collectible art form than actually an auto. They are currently developing their first full battery electric vehicle. The CEO of Ferrari has already test driven this in private last year, declared it to be a great car. They are targeting about 40% of their cars to be fully electric by 2030. But just given what's happening in the EV market, I'm pretty sure that's going to be a moving target and will be pushed out quite a bit. Now, we've all heard that the EU is talking about, banning all petrol and diesel cars by 2035. I think most think that this is going to get pushed out. There's no doubt that an all-electric Ferrari brand probably wouldn't have quite the same appeal than if they were still allowed to produce some petrol cars. And a lot of the supercar brands in Europe have been lobbying to get the rollout of electric power in the supercar brands to be a lot slower than the mass brands. And I'm pretty sure, given what they mean to the economies of Italy and France and Germany, that they're likely to succeed on that as well. And then there's even that argument that says that if one looks at the luxury or the watch market, that the rollout of Apple watches and all the wearable sports brands that we all wear has absolutely killed the mid-market in watches, but it's actually enhanced the value of the ultra high-end mechanical watches. So, in a world where, internal combustion engines become more and more rare, these very high-end companies that are likely to still be allowed to produce this very small number of the internal combustion engines, they could actually be considered, objects of increasingly rare value, over time, with a very low impact on the environment. Pivoting back then, to Ferrari, they're a company that doesn't advertise much, but what they do is they push very hard in Formula One. So they are the only Formula One company that have been there every year since its inception, of Formula One in 1950. They don't really advertise. Instead, they use Formula One to push the brand, and they do also get some extra revenue from their Formula One sponsorships. One of the areas where Ferrari has materially increased their profitability over the last few years has been with these very high-end customizations. And you can actually add a few $100,000 to the cost of a Ferrari with these customizations. And they range anything from, just sitting at the dealership and, ordering a few of your own ideas, to actually traveling to one of these centers in, Italy or the US or China, where you actually sit there and spend hundreds of thousands of dollars on everything from hand-painted badges to your own stitching on your steering wheel. Just tilting to Ferrari's actual model, and I'll go through these slides pretty quickly. This is all in hard currency euro terms. We see the significant growth that they've achieved in their top line, over the last a few years. Their production volumes, there's a misperception out there that because their volumes are so small and they're very much a luxury company, that they are no volume growth model. And they actually address this point themselves in their 2022 annual report, where they actually mention the fact that they've pretty much doubled their volumes since the IPO. And there's definitely scope for them to slowly increase this to about 20,000 cars, over the next 10 years or so, by tapping into new markets without actually damaging the brand and still being a very, very small volume producer. Their margins are absolutely phenomenal. They're very much up there with, luxury brands, type of volumes, gross and operating margins. And the net effect of this has been, about a 20% hard currency earnings growth CAGR over the last 10 years or so since they IPO'd. So it really has been a financial, a phenomenal performance. Just my final slide on Ferrari, there's obviously going to be a fly in the ointment. And as always with these kind of companies, it's the valuation, where Ferrari trades pretty much on a Hermes type of ultra high-end luxury valuation. It's always been an expensive stock. The analysts in the market who've covered this company over the years have consistently agonized over the type of multiples that it trades on. But even by its own lofty standards, we would have to say that Ferrari is quite expensive at the moment. So a phenomenal business, maybe just tactically not the best time to be buying it right now. And, hopefully for all of us, it will present a better opportunity, maybe in a broader market sell-off, which we can never predict, but inevitably will come somewhere down the line. Right, then just pivoting for an update on Tesla. They did actually release their results last night. I mean, it's been a very, very tricky year for Tesla in 24. After being a great performer, doubling in 2023, it's been by far the worst performer of the so-called Magnificent Seven in 2024. Now, Tesla is the exact opposite of Ferrari. A Ferrari has absolutely no utility value. A Tesla is just pure utility value, especially when you start getting into autonomous driving. There's so much going on at the company, so much debate at the moment. Reuters came out with an article recently saying that Tesla was scrapping their new entry-level car. Elon Musk came back on Twitter that evening and said, Reuters are lying again, in brackets. And even on their results call last night, they sort of said they still, going down this route, although they wouldn't be drawn exactly on whether it's going to be an all-new entry-level car or whether it's just going to be the existing cars that kind of get downscaled and kind of cheapened up into entry-level models. Now, the thing that's worth bearing in mind is, yes, Tesla is taking strain at the moment, but it's the whole global EV market. So it's one of those classic situations where you have a down cycle. Yes, the leader like Tesla takes strain, but everybody takes strain. And actually the weaker competition actually gets flushed out, such that when you get into the next EV upcycle, Tesla actually comes back in a stronger competitive positioning, and especially outside of China as well. It's a company, again, that's not widely held at Anchor. We do follow it very closely to see whether one of these days we might get an opportunity in it. it is worth bearing in mind that it is still a significantly sized company with a $500 billion market cap. And for us, Tesla isn't really about the valuation multiple, over the next 12 months. And in fact, on their results call last night, Elon Musk spoke a huge amount about their push into autonomous driving. And he just made the point that, if you don't believe that autonomy will ever be fully legalized, you probably don't want to invest in Tesla. But if it is, it's going to be an absolute game changer for this company. Here's a slide that is just worth keeping in mind about EVs, which, have clearly gone into a bit of a winter in 2024. And that it's just a scientific statement of fact that the energy conversion, the go forward energy in an EV is significantly higher than in an internal combustion engine. In fact, it might even be by a factor of about 4x. So, the day that, environmental issues start coming into the forefront again, there's absolutely no ways that the world is going to all go back to just driving, petrol cars. EVs are here to stay. They're not going to save the world, but environmentally, it's definitely a very big step in the right direction. And there will almost certainly be another EV upcycled down the line. This was an interview that Elon Musk had in November last year with Ron Barron, who's one of the key shareholders in Tesla. And he spoke about this again last night, where they're just saying that, autonomy is not a question of if, but when. The new FSD, full self-driving 12 software that was released recently is really, really a phenomenal product. And they feel that they are very, very close to getting to the point of mass scale adoption of full self-driving. And when that happens, the utility value of a car that can do full level 5 self-driving, that's where you don't even need a driver in the car or the driver sitting on the back seat, is materially higher. Then you go from, let's say, a Ferrari being driven 1 hour a week to a regular petrol car being driven 10 hours a week to an autonomous car that can be driven 50 or 60 hours a week. The utility value of that car goes up absolutely material. And that's where it becomes a game changer for Tesla. Almost at the end of my slides, this chart has subsequently been updated last night. We already knew anecdotally that Tesla is now sitting with over 1 billion miles of testing of full self-driving. So the database that these guys have built is unparalleled in the industry. And at some point, this will certainly be worth something material to Tesla as a company. It's going to be very much a winner-takes-all market as well. And then don't forget, with Tesla, you've got all of these other areas as well, the solar, the energy, battery side. There's just a huge amount going on in this company away from just selling, EVs. And then our final conclusion slide is that, as always, Tesla remains, the Kool-Aid stock. Now, I would say that this is probably the most divisive company in the S&P 500, between the people that absolutely love it, think it will be the biggest market cap company in the world in the coming years, other people that just, don't like Elon Musk, don't trust what he says, and think that it's hugely overvalued. So yeah, it's very much an every person for themselves kind of stock. That's the end of my presentation, and I'm going to head back to Pete Armitage.
Well, thanks, James. Always interesting to look at some specific shares. Guys, from a timeline point of view, for those of you who joined, we try and keep the whole sessions to about 90 minutes. We're running well on time. I'm going to have a quick Q&A with Thomas Hendricks, who is part of our fixed income team, has been with Anchor for quite a few years. And it's really, he wrote a very interesting article together with Casey, which is in our latest Navigator presentation, focusing on the US 10-year government bond. It seems like a very boring topic for most of you, I guess, but we're trying to add a bit of life and simplicity to it. And you'll often hear it talked about in almost every investment presentation that we host, and certainly that others host. So, Thomas, we're going to pull the cover off the US 10-year government bond. So what does it all mean? I mean, it's been as low as 1% a few years ago. It's currently 4.5%. What do you buy when you're buying a US 10-year government bond?
Yeah, Peter, so essentially when you buy the US 10-year, you're just buying essentially a loan to the US government. So you're loaning the US government money for 10 years. The promise is that they will pay you back a coupon that's predetermined biannually, and they'll pay you back the value of your purchase at maturity. So if you bought $100 worth of bonds today, you'd get a coupon every 6 months, and you'd get the $100 back at maturity 10 years later.
So if you put down $100, you get basically around $4.50 a year and $10 back at the end. So you make about your $100 will be worth about $150 at the end of the 10-year period. Obviously,
Yeah,
depending
so
on
right now,
those $4.50 that you earned.
yeah, so right now you're getting about 4.7%, I think is where the yield is right now. I think the at issue bond is paying a coupon of 2% twice a year. So you'd actually get 4% of your $100 back per year, but the yield is slightly higher than that because the bond is trading at a slight discount. As Nolan showed a good few slides ago now, the yield has climbed over the last while.
So when we look at a share price, a share that's $100, if the value goes up, it goes to $105, and it's easy to picture that. Bonds are priced as a yield as opposed to capital. Maybe just explain that concept.
Yeah, so on the bonds, as the yield moves up and down, so right now Nolan was talking about sort of 4.7%, I think is around about where we are today. That obviously implies that the bond value changes as the yield goes up and down. So we call that duration, and basically it's a measure of how much sensitivity the price has to the yield because of the relationship between the two.
Sorry, if I can just say at this stage as well, we do have a Q&A, and this will be about another 5 minutes, and then we're going to go through the questions that have popped up from people who are watching. So why is it so important, and why is it considered the benchmark for the pricing of money around the world?
Yeah, well, I mean, the key question here just comes down to the US dollar being the currency of global trade. So because most trading partners have to hold USD, it means that their reserves have to be held in the most secure dollar investment that you can have, and that is treasuries. So, I mean, if you put your dollars into a dollar-based bank account, the bank on the back end would be putting those into treasuries. And the reason for that is because of the very low credit risk attached to treasuries.
So why is it considered risk-free? I mean, why is it less risky than lending money to anybody else?
Yeah, so, I mean, fundamentally, the US government controls the supply of dollars. So the credit risk attached to a treasury is very low. If you bought US treasuries today, the odds that the US government is going to be unable to print money to pay you back tomorrow is very low. So that's why it's commonly used as a risk-free measure. So if you, as an investor, are to justify taking on additional risk, the reward that's offered to you needs to be above the level offered by treasuries.
So that's kind of really the key of it, is I can lend money to the US government and earn 4.7%. So if I lend money to anybody else, then I'm taking more risk for the same duration. I'd expect to get a high yield. And I guess that's the bottom line. So to try and put in context the maths of it. So if the yield goes from 5% to 4%, what's happened to your capital value?
Yeah, so the bond price and the bond yield is linked inversely, and we call that duration. So if your bond yielded 5% yesterday and you woke up today and it was yielding 4%, you would have made a profit because the duration of US 10-year, for example, is approximately 8. So if US 10-year was yielding 5% and a day later was yielding 4%, you'd make about 8 times the duration, 8, which is the duration, multiplied by that percentage change. So just to use an example, sorry, it's slightly the inverse, but let's use the real example. The investors in Feb who bought treasuries, the yield has moved from 4% to 4.7%, and those investors have lost about 5% of their capital value in that period. So it's been about 2 months since then.
Okay, so they can have some volatility and change in capital value, but if you hold it to the end, you're going to get that final value at the end, although the price can fluctuate along the way. So people often look at balanced portfolios, and they have a portion in equities and a portion in bonds. And I think an important point to make, and maybe if you can expand on it and explain why, often when equities are going down, the value of bonds are going up. So that it gives that kind of cushioning effect.
Yeah, so generally, I mean, this is, again, broadly, we view equities as a riskier class of investments than bonds. So when market sentiment turns sort of more risk on as opposed to risk off, investors will move from a less risky investment like bonds towards a more risky investment like equities, because they obviously believe that the risk reward dynamics favor that investment. As that happens, obviously, if you've got investors moving out of a certain asset class towards another asset class, obviously the yields will increase, the price will decrease as equity prices rise, because that market starts to become more crowded. So, and in the converse, obviously, the exact opposite happens.
Okay, so they've got attraction not just for absolute returns, but from a portfolio perspective to give you that balance. What are the three biggest factors that will impact the yield of the US 10-year government bond over time?
Yeah, so I think obviously we're just going to tease out the biggest three, but there are dozens. But the three biggest ones that I've highlighted here are inflation expectations, which I think Nolan spoke about a bit. And that's obviously lenders are going to require a rate of return that outperforms CPI to justify holding a riskless instrument. Because otherwise, if your money is going to underperform CPI, there will be no point in loaning your money.
It's the
Second,
concept of a real return.
Yeah, exactly. So you would want your return to be, the return implied by the bond less CPI to be a positive number. Secondly, reserve expectations. So in this case, the Fed. So the Federal Reserve determines monetary policy and obviously essentially determine the ease of access to capital. So as capital is more readily available, it means that low-risk investments become less attractive. So that can tighten yields on low-risk investments because now there's more cash available in the system. And obviously, in the opposite case, when they tighten monetary policy, low-risk investments become less valuable because cash is less easily accessible. And the last one was sort of, again, a sort of global risk sentiment. If you have massive global adverse risk shocks, so COVID would be a great example, you have a massive flight towards safety where people sell off any risky investments that they might hold and move towards this, what is perceived as the safest investment that one could hold, and then US Treasury will generally drop in yield and increase in price, which is exactly what we saw happen in sort of March 2020.
Okay, then one last question. Maybe just explain the relevance of the US 10-year government bond. So that's sitting at about 4.7%. Talk us through the South African 10-year government bond, which is trading at more than double that. And how does the one impact the other? And how much more should you get in South African rands than US? How do you view that?
Yeah, so obviously, because South Africa's market perception, the risk of South Africa is, the market perception is that South Africa is riskier than the US, and that's reflected. So like we said, our South African 10-year, you're looking at something in the neighborhood of 12.3%, and like you said, 4.7% for the US, both in our domestic currency. So that's rand yields for South African 10-year. But we also issue US debt in South Africa, so you can kind of strip out any ZAR impact, and usually we call that a SOAF, and a 10-year SOAF yields something in the neighborhood of 8%. So even stripping out any kind of currency effect, just looking at how much does South Africa yield as opposed to the US for similar term, you can say something like 8%. So that's a 3.3% difference, or sorry, yeah, 3.3% difference.
So that kind of reflects the country risk, I guess.
Yeah, so you can start sort of narrowing into specific risks that are more idiosyncratic to South Africa rather than global. And generally, the reason that the US 10-year is so important for us and for other market participants across the world is because it's used as the benchmark rate when you build up a model of how do you value other investments. So relative attraction is always going to be based on the safest possible investment for your dollar, which hard currency, which is going to be the US 10-year.
Okay, fantastic. I think that's helped us all understand. It's actually quite a simple concept, but communicates it the opposite way to equities. I think confuses a lot of people. Right, thanks, guys. If I can ask you to put your screens back on. There's some questions we want to kick through. We're going to try and wrap it up in 5 minutes or so. But Liam, maybe if you can start with a question on the SA equity front and your bullishness on the shares. Are you talking about Rand Hedge shares, or does that include SA Inc. shares? We also can't see your face there.
Yeah, the camera's not picking me up with this new background. There we go. Sorry.
Liam's just traveled across the world to join us again.
So Pete, the models are suggesting that the biggest upside lies in where the most pain has recently been felt, and that's really in the domestic categories on the JSE. So, you know, the flexibility or the sensitivity analysis we did to get to the numbers was just to take a look at where our domestics are trading relative to their mean over the last 5 years, and we used the last 5 years because it excluded the high rated years that we had in the early 2010s and before that, and it includes, you know, very tough periods like COVID and the July unrest, the emerging markets breakdown as well, and South Africa's alignment with strange characters like Russia and Iran and those places, or at least from the investor perception. So it's included quite a tough period over the JSE, and even right now, our domestics are trading at quite a significant discount to where they've been over the last 5 years. So our sort of conclusion is not a lot needs to really happen. I think that there's quite a lot of investor inertia going into the elections. And on the other side of the elections, coupled with our base case of a benign outcome, which we discussed, we think that there's going to be some form of relief in that domestic category on the JSE. And it probably won't be a rising tide or lift all boats. There's certainly some companies that have suffered at more structural issues. I mean, you think of healthcare and the overhang from things like NHI and on companies like our hospitals and Discovery. But certainly across big parts of big index weightings on the JSE, there's certainly an argument to be made that they're probably being a little bit unfairly treated right now. Yeah.
Okay, fantastic. 2 currency questions for you, Nolan. What do you think about the trend of de-dollarization? And then another question going, wouldn't the commodity index be more appropriate than the PPP methodology that you use in the fair value of the currency calculation?
Thanks, Pete. Let's chat about the commodity index first. The Rand is a commodity currency, absolutely no doubt about it. And when commodity currencies are generally stronger, i.e. when they're benefiting from high commodity prices, the Rand looks strong along with the Aussie dollar, other commodity currencies. And you can see that very strongly in the PPP chart around 2004 to 2010, when the Rand was stronger than we'd argued. Conversely, at the moment, the commodity currencies are undervalued. There is no individual model that perfectly explains what's happening within the Rand. It's a particularly complicated environment. And in fact, there was a study done previously that said, you know, you can look at all of these different models, and what you're going to find is that in the short term, actually all of them are pretty rubbish. And the best value for the Rand is in a year's time is kind of where it's at today, and just assume it's not going to change. So that's kind of what the models came out with, is to say it's very, very difficult. Why do we go with the PPP? We go with the PPP model because it looks at the inflation differential between the two countries, USA and South Africa. And historic experience has said that in the short term, everything is pretty ineffective. But over the long term, a PPP chart like this actually does explain something like 90 to 95% of the currency movements, if we start talking in years and decades rather than 6-month quarterly type profiles. So from that perspective, it does have a lot of merit. It has been proven to be successful, and we accept that in the short term, it's going to be a little bit out. The de-dollarization, looking at that, we actually published an article on our website. You can probably still go and find it. I want to say about a year ago, might be slightly more than a year ago, but you will definitely find our discussion on that. And the discussion is real. I think de-dollarization is clearly happening, but the point we make is that it is incredibly slow, and it's going to be a slow process. You know, the countries that typically are anti the West, that talk about using their own currencies, typically find that their currencies unfortunately lack a sense of trust in those countries. I know at one stage, you know, the BRICS were saying, well, we'll combine all of our currencies. You'll have a bit of the Argentine peso and the rand and everything else. It's not quite competitive. So, you know, where we came out when we looked at it is to say that clearly the volume of trade in dollars is going to be less over time. However, for the foreseeable future, this is going to be a very gradual process. And therefore, we think that, you know, the reserve currency of the world is going to continue to be the US dollar. And as such, you know, that's what we look at first and foremost, value of the rand or value of a commodity.
Okay, let's swing back into one of people's favorite topics in the world is Tesla, James. We have an entry price level. Well, how should we see the value?
So you're saying at what level should we be looking at an entry point?
Yeah, that's the question.
Yes. So look, I think the point is if you value Tesla just as an EV producer, you know, people have somewhere between maybe $60 or $100 a share. So for me, when you start getting into the low hundreds, below 120, and look, it's rallying today on the results, but it was in the low 140s yesterday. I think 120 and below, you're getting to the point where you virtually are just valuing the EV business, and you're not putting really any value on the autonomy, you know, the energy storage, the servicing of cars, the leasing business, and robotics as well, which is going to be huge in the coming years. So you want to get to that point where you're kind of just buying the EV business and getting everything else for free. And to me, that's, yeah, as you get closer to 100, you start playing with that scenario.
That's when value investors might
yes, exactly.
There's then a few questions around the SA regulatory framework. So for people who are listening who aren't aware, one of the big factors, the technical factors in our market over the course of the last few years is Regulation 28 funds and SA asset managers were allowed to move their offshore allocation from 25% to 45%, which resulted in quite a big drain in the SA equity market as SA equities were sold and global equities were bought. Now, there's some talk and a question on the Q&A of, you know, is it possible that could come back from 45 to 30? I'm not sure the authorities all thought collectively and realized the implications of what could happen. And prescribed assets, you know, always pop up as another idea when somebody else gets into kind of any position of financial power. They talk about it. Prescribed assets is often what that means is telling pension funds that they have to invest a certain amount in assets which are prescribed, like SA infrastructure, etc., as part of a funding mechanism. So what are the chances of those happening? And tied to that whole kind of SA story is a question about, does grey listing get, you know, can we come back from it? Can it be removed? So maybe just to go around the room a little bit, just to get some views on, and really it's just the SA regulatory environment and the rules around management of money, because those rules can have an impact on the value of your investment. Nolan, perhaps a starting comment from you, and then Thomas, if you want to add to that.
Sure. So this whole talk of Regulation 28 and should we roll it back started with a comment the finance minister made at a breakfast hosted by one of the banks here in Cape Town. As luck would have it, I was actually at the breakfast with a variety of other asset managers. And what happened is a question pertaining, you know, to this sort of impact on the JSE came up. And the finance minister and advisors sort of looked a bit uncomfortable for a few minutes, and then specifically the finance minister sort of responded. And his first comment was that the expansion of Regulation 28 to allow more money offshore was, in his mind, a mistake. And I got the sense that he'd sort of pushed it through a bit, but, you know, hadn't quite understood the ramifications and regretted a bit now. But the second comment he made, almost with the same breath, was to say that, you know, it's very difficult to unscramble the egg. And he doesn't really see how one can pragmatically roll this back. So my takeaway from that breakfast was, yeah, they're not delighted with the outcome, but it is what it is, and they're going to live with it. Interestingly, the bank in question then put out an article that said they're re-looking at it, which certainly wasn't what I walked away from that breakfast with. But that's kind of where the can of worms got opened again. What's my takeaway on it? You know, as I said then, I'll say now, if you want me to invest in a sensible project in South Africa, we have, you know, a vast array of fixed income funds that we are constantly working to deploy, and we will gladly do it. We just need a viable project to fund something sensible in SA, and we need to have a good sense that the project's properly structured. There's no point in prescribed assets. You know, it's a quick fix to a problem that doesn't exist. Rather put down sensible plans on you know, developing infrastructure, give us an opportunity to participate. There's a lot of money on the sideline that would love to do so. So I think from that perspective, you know, it then becomes an ideological debate of, it's easier to tell you to put the money in there rather than to structure the projects and what have you. And that's an ongoing debate. I think South Africans are fearful of the government in many respects. This is one of the areas where it comes up, and it comes up every election cycle where things could change. My personal perspective, probably not. I certainly didn't get the sense that that was something that was on the cards when the minister was talking. I kind of felt the minister was maybe a bit more free market oriented, and he accepts that, you know, given the country's borrowing requirement, he needs to do things that are sensible for broader investors right now. He can't afford to alienate investors with knee-jerk things like this.
Okay, I think we're getting pretty much to the end of our time. I'm going to hit James Bennett with one last bomb. What's the investment strategy in terms of a potential world war that's coming our way, is the question.
I don't think there is one for that. I always have that saying that you can't financially plan for World War III. And I wrote that piece on optimism, remember, a couple of months back, where all you can do as an investor is just assume that the world, as you know it, will continue as a going concern. If it's World War III, I just think all bets are off, and a value or a growth or an index hugging strategy, it's probably all going to get buried. So yeah, it's almost impossible to even think of planning for that. Even cash under the mattress probably won't save you in a rampant inflationary environment. So,
well, there's a lot of cash under mattresses in South Africa, I think.
Yes.
Okay, guys. Thank you very much. We hope you enjoyed that. There have been a lot of participants in the call. We hope you found that instructive. And if you've got any questions, speak to wealth managers at Anchor or the financial advisor that you come through, or if you're a financial advisor, feel free to ask us for our Navigator document, which details everything we've been through today. Or you can get that on our website. Thank you very much, and be optimistic.
Thanks, everyone.
Have a good rest of the day.
Thanks very much.